Good morning, good afternoon, good evening, wherever you are around the world. Thanks again for joining us. Assalamu alaikum. My name is Nadeem Mia. I'm the portfolio manager for ShariaPortfolio Canada, based here in the Greater Toronto area. With us today, for our webinar, we have our guest, Wayne Bewick. And the topic of today's webinar is going to be navigating personal international tax issues for expats and new residents. Before we get started, let me just tell you, let me get started by first, one second here. Just a quick disclaimer here. The information that we're going to be presenting today is for information purposes only. We strongly, suggest that you speak to your financial or your tax advisor for any, professional advice. And also the parties today, with ShariaPortfolio and Trowbridge, there is no compensation or referral agreements in place, so neither parties are being compensated for this event today. So the agenda for today, just a quick welcome introduction, which I'm kind of doing right now. I'm going to spend maybe about 5 minutes talking about ShariaPortfolio Canada, who we are and what we do. And then, of course, the main event is going to be, Wayne Bewick and his presentation, along with his colleague, Arun Nagratha. And then, of course, we're going to conclude the session with a healthy Q&A. You can enter your questions in the Q&A box if you just click onto the link there. Please enter your Q&A even during the course of the presentation. We can kind of queue up the questions towards the end of the presentation, and hopefully we'll get around to answering that. So just a quick background for those newcomers to ShariaPortfolio, who we are. ShariaPortfolio started in about 2003 with our founder, Norshad Virji. At that time, it was titled Virji Investments, small operation at that time, only operating in about 5 states. In the course of the year, as demand grew, in 2014, we expanded into 26 states, rebranding ourselves and at the same time being registered with the SEC in the US. This, of course, is the parent company. And then, a few years later in 2017 and 2018, the company started to kind of kick the tires and expanding into Canada. By 2019 is when we really kind of started to get our registration. That's when we received our Canadian registration, and we were officially in business in Canada. Now, our Canadian office does deal with a lot of the international clients. And we'll obviously be talking about that, and I'd be happy to answer any of your questions. We also have our sister company, SP Funds, which some of you know have launched 3 ETFs on the New York Stock Exchange, SPUS, SPSK, and the SPRE, which is the new real estate fund. So just some quick background on ShariaPortfolio, specifically in Canada, what we do. We are professionally actively portfolio managers. We're currently registered in the provinces of Ontario, Alberta, British Columbia, and Manitoba. Like I mentioned, ShariaPortfolio was founded in 2003 with its parent company. And we do have clients across Canada and actually even around the world. That's something that, one of the reasons why we are doing this webinar today, because we obviously get a lot of interest from international clients. We're a firm that's very dedicated to Sharia compliance, as our name kind of implies. That is, our focus, really. We are currently partnered up with Fidelity Investments. That is our custodian bank. So all the back office, the administration, the trading, everything is done through Fidelity. And Fidelity is, I think, the 3rd largest asset manager in the world. Currently, we have 2 types of services that we offer. Access, which is kind of our premier solution. Minimum account size is about 100,000. That's where we do actively manage your portfolio using not just ETFs, but individual stocks. And we have the express service as well, which is more of an economical solution, ETF models strictly only, but a perfect solution for what we think are for new investors. Now, so that's a little bit about us. Now let me just introduce to you our featured guest speaker, Wayne Bewick. As an experienced Canadian chartered professional accountant and a certified financial planner and a U.S. certified public accountant, Wayne leads a private client division at Trowbridge and thrives on problem solving and making complex tax matters less daunting for international clients. Wayne is frequently sought out as a panelist and subject matter expert, presenting worldwide on tax compliancy issues and tax obligations for expats living and working abroad. When he's not doing the fun stuff with taxes, Wayne, like myself, is an ex-Montrealer. He's an alumni of Concordia University and a huge fan of the great Montreal Canadiens. So without further ado, I'm going to introduce Wayne. And Wayne, you will obviously introduce your colleague Arun as well. So take it away, Wayne.
Oh, I'm going to share my screen here. All right, so thanks to Nadeem and ShariaPortfolio. I've known Nadeem for quite a few years now, so I'm glad we've been talking about doing this. So I'm glad we put this together. So as Nadeem mentioned, I'm a partner or managing director, I guess, with Trowbridge, and we specialize in expat tax. We've been around now for 18 and a half years, which seems like a long time. It seems like just yesterday we started. And we have, I focus on working with Canadians that work around the world and individuals that are moving to Canada. We also do a lot of US tax. We help companies coming in, and Ernie, who will speak a bit later, works in our global mobility group. So I've been very fortunate to have traveled a lot and done a lot of presentations, and especially in the GCC. I first presented in Kuwait in 2006, and I've presented there every year since. So I normally do Kuwait, Abu Dhabi, Dubai, Qatar, and then I've done a few spots in Saudi as well, Riyadh, Dammam down in the eastern provinces. I'll normally stay in Bahrain when I'm there though, and in Jeddah on the Red Sea. So we have a lot of experience in this area helping people who have moved there and people that are moving from that part of the world. So I'm going to touch on a whole host of things. I'll try to keep to 30 minutes. Sometimes I tend to keep going on. But what I'm going to talk about is I'll start talking about residency status, whether you're a Canadian resident for tax purposes or not. I'll talk about whether you have a principal residence, Ernie will actually, if you've moved abroad and you still have that. How do you get out of the Canadian tax system if you're living abroad? Voluntary disclosure, if you need to come clean on some issues. Fixing up Canadian tax returns, and then returning or moving to Canada, and all of the issues that are with that, including reporting of foreign assets and such. So, and then I look forward to the Q&A at the end. There's always a lot of interesting questions. So just to kind of talk about a few things that are new, is that the CRA is sort of focusing on people that have assets abroad and they're not reporting them. So there's been a big push on that. I'll give you an example. So we had, so what happens now is any transfers of $10,000 or more to Canada, the CRA gets copies of those transfers. And now, those transfers used to go through anti-money laundering and anti-terrorism, but now the CRA also gets them. Now, if you're transferring money to Canada and everything is legal and fine, there's nothing to worry about. So if you're working abroad or you just want to send money to, children that are in school here or anything like that, or you want to invest, there's no problem. But if you're a Canadian resident and you have assets abroad that you haven't reported, the CRA is looking to do that. So we had one client who had money in Kuwait, and they never reported it on the Canadian return. And what they did is they transferred $500,000 to Canada 2 times, and then the CRA asked where this money was coming from. So that's sort of where they're looking at compliance issues. If you have more than $100,000 of assets outside Canada, there's a T1135 form that you have to file, so you have to disclose all these assets. There's also a new whistleblower program, which is kind of interesting. So if you owe more than $100,000 of tax because of unreported income, if someone calls the CRA and tells you about it, they're eligible for a bonus of up to 15%. So, so what we've seen, and the funny thing is, what's happened is the people that are normally calling the whistleblower program are disgruntled ex-spouses. So the ex-spouses have been reporting people that have been hiding money abroad. So I think what this shows is that there's just a real target on assets abroad. So it's just important to ensure that everything is reported properly. There's also been the foreign buyers tax in Vancouver and Toronto, and also a BC speculation tax and a Vancouver empty home tax. And this is a bit of a misnomer in that, you know, if you buy a home in, you know, the Golden Horseshoe or in Vancouver, they call it a non-resident surtax, where you have to pay 15 or 20% extra in tax. And it doesn't apply to citizens or permanent residents. So it's not really a non-resident tax, but so if you're a citizen or a permanent resident and you're looking to buy property in Canada when you're living abroad, that's not a problem. One other thing I did want to speak about is the CRA and the delays. So anytime, you know, there's an international tax issue and you're dealing with the CRA, like sometimes things are taking up to 2 years. So if you're working with the CRA and you have an international tax issue, don't be surprised if it takes forever to get this things processed. Especially this year, because a lot of the international tax people in the CRA were moved over to help with a lot of the COVID issues. So they're really, things are just really slow there. I mentioned this because we get a lot of calls from our clients and they're like, what's going on? Why haven't I heard from the CRA? So I like to pre-warn people that there's some delays. There's also the common reporting standards. So if you get a message from, you know, your bank or a form to fill out asking where you're a resident of, you know, a lot of times our clients are really worried about that. That is just a standard form that the banks are sending out, so you don't have to worry about it. But you should ensure you fill it out correctly. So if you're not a resident of Canada, it's important to ensure that you mention whatever country you're living in, because otherwise Canada will get a copy of the income and will expect you to file a tax return. So again, there's nothing to worry about there, but just make sure you fill that out properly. There were a bunch of government incentives earlier this year that I'm not going to talk about, but one thing is that a lot of these benefits are taxable and there might not have been tax withheld. So you'll want to make sure you file your tax return on time, because this could be the 1 year where you owe tax in Canada, where in the past you might not have. So this is one that, this is a slide that I always kind of enjoy doing. This is why I enjoy working with people in the Gulf, because you know, or lower tax regions, because the tax rate in Canada is extremely high, as a lot of you know. And so most provinces now, once you've reached about $200,000 of income, the top tax rate is over 200,000. It's over 50% in most provinces, as you'll see. And so how Canada does things, if you're a resident of Canada for tax purposes, you're taxed on your worldwide income, which includes income in Canada and income anywhere in the world. So, you know, if you have a rental property in, say, Dubai or somewhere else, you have to include that income if you're a resident of Canada for tax purposes. But if you're a non-resident, you don't have to include that income. So if you're working abroad and you've done things properly, you don't have to pay tax on that income. And that's why it's incredibly important to ensure, especially for those that are living abroad or those that are thinking of moving abroad, that you handle your residency status correctly. And one thing is that residency and immigration are two completely separate things. You know, they sort of intertwine a bit if you're applying for permanent residency. So you need to make sure you don't get too many ties to Canada. But in general, immigration and taxation are completely separate. So as an example, if you're living abroad and you're making $100,000 a year, if you're a resident of Canada for tax purposes, you pay $27,000 in Canada. And if you're a non-resident, you pay zero in tax. $200,000 salary. And the thing about living abroad is a lot of times people get housing benefits or they get school benefits or anything like that. Those are all taxable benefits. So those add up to your salary. So on 200,000, you pay 73,000 a year as a resident for tax purposes and zero as a non-resident. And you can sort of see how everything adds up over 3 years. So for those that are living abroad, hopefully most of you have become non-resident, or you're going to do it, and make sure you do it properly. So how do you become a non-resident? And this is one of those things that's unfortunately is not clearly defined. So the Canada Revenue Agency looks at your ties to Canada, and then when you leave, they look at your intentions to stay abroad. And some of the major ties they look at, they say, well, do you have a home that's empty in Canada? Because that would be a major tie. So we would recommend renting it out or selling it. Have you left behind your spouse and your children in Canada? Because that's a major tie. And do you have a job available back in Canada? So those are the 3 big ties. And so if you have one of those ties, then it becomes a lot harder to become a non-resident of Canada. Then there's also a whole host of secondary ties that the CRA will look at. Do you have Canadian bank accounts? Do you have Canadian credit cards? Have you maintained your Ontario provincial health coverage? Do you have your Canadian driver's license? So these are various other ties as well. Now, having a few of these won't necessarily make you a resident of Canada for tax purposes, but we recommend minimizing as many of your ties as possible. Now, one thing is there's a form called the NR73, which is a determination of residency status. We recommend never completing that form and sending it in. The one reason is you don't have to fill it out unless the CRA recommends it. And there's a bunch of trick questions on that can, that if you answer in the wrong way, the CRA can deem you to be a resident of Canada for tax purposes, even if you're living abroad. So a lot of times we see people come across that form, they send it in, and then they get negative feedback from the CRA. So again, just be careful of the forms that you're sending to the government. One other way is to become a resident of Canada for tax purposes, and I'm going to talk a little bit more about that, especially this year, because Canadians that were living abroad spent a lot more time in Canada because of COVID. And so there's a 183-day rule as well. So if you don't have a lot of ties to Canada, but you spend more than 183 days, you can be a deemed resident of Canada under the sojourner rule. And so what we see that is we see, a couple will move abroad, and then all of a sudden one spouse comes back and spends a lot of time in Canada, whether it's an ailing parent or there's other reasons, and then they pass 183 days, and then they've created a whole host of problems. So it's just something to be aware of if you're spending more than 183 days of the year in Canada, because then you end up becoming taxed on your worldwide income for that year. Now, what happens is if you're a resident of a country that has a treaty, it's a lot easier to become a deemed non-resident of Canada. So for example, if you move to the US or you move to say, Thailand or anywhere where there's a tax treaty, it's a lot easier to become a non-resident. Now, what happens is, unfortunately, under a lot of the treaties, like Canada doesn't have a tax treaty in a lot of countries, for example, the UAE and Kuwait. And even to qualify under that treaty, if you're living there, you have to be an Emirati or a Kuwaiti citizen. So a lot of times people will say, well, I'm a non-resident under the treaty. So you have to look at each specific country that you're in to see how the treaty plays in there. So a residency can be quite complicated. So that's why it's just important to ensure that you're working with someone that understands all the various implications of both domestic Canadian tax law and the international tax treaties. Okay, so for the individuals that are left or moving abroad, it's important to ensure that you get out of the Canadian tax system properly. And you do that by filing what's called a Canadian departure tax return. And so that's a normal tax return, but on the front page, there's a box that says, did you enter or leave Canada? And if you haven't filled out that box properly, then you're still a resident of Canada for tax purposes, and you're still taxable on your worldwide income. So what we see a lot of times is people move abroad and they stop filing, but they don't do the last return correctly. And that means they're not out of the Canadian tax system technically. On the departure tax return, there's a bunch of other forms and differences that need to be taken into account. For example, if you have more than $25,000 of assets, you need to fill out a special form. Otherwise, there's a $2,500 penalty. And so we see situations all the time where, you know, the husband and wife will have properties and they haven't filled out this form, and all of a sudden there's $5,000 in penalties. So again, for those that have left Canada or thinking of leaving Canada, it's important to ensure that the person you're working with has the international expertise to make sure that the final tax return is taken care of properly. So for this year, again, what we've seen is that there's been a lot of people that came to Canada and stayed in Canada, and they were worried about their residency situation. And so the CRA was actually proactive, and they came out, and I think it was between, I think it was February 29th and September 30th or something like that, where they said any of the days that you were in Canada because of COVID, if you plan to return to the country of origin or where you're living, those days wouldn't count for purposes of, you know, the sojourner rule, the 183-day rule in Canada, and for other things. So this year is a very different year in terms of dealing with residency for tax purposes. And I'll go through a few examples. So again, in the first one, you know, where someone came to Canada in February and they weren't able to go back to, say, the UAE or Qatar or wherever they wanted to go back to because they couldn't get in because of the foreign country, or it was too dangerous for them to leave because of traveling through airports and everything like that. The CRA said, you know what, we're not going to count those days, and we're not going to make you a resident for tax purposes, which was quite, again, proactive of them. There was other situations we had where clients would come back, and I'm just using the UAE because I just did Abu Dhabi and Dubai presentations last week. So people came back in February and they're fully expecting to leave and move back, but all of a sudden say they lost their job or their situation changed and they didn't go back. Normally someone becomes a resident of Canada for tax purposes on the day they land and say they come with their family. But in certain instances, this is a different situation. People might have intended to go back. So when does the residency for Canada for tax purposes start? And again, why this is really important is because the day you become a resident, you're taxed on your worldwide income. So that's why it's important to figure that out. We also had a situation where one client, this was in Qatar actually, where, you know, the one person moved to Qatar and the family and spouse were supposed to follow in September of last year, but they couldn't because everything was closed down. They couldn't get into schools and various other things. Normally, both spouses, their residency situation is the same. They're both residents for tax purposes, or they're both non-residents for tax purposes. But in this instance, where where the full intention was to go, there was just no possibility. You know, we're looking at potentially treating one person as a non-resident and one person as a resident. Other situations, you know, say someone moved abroad for 6 months or 8 months and they planned on staying abroad, but because of the global slowdown, they lost their job and came back. So we've had situations where people have gone abroad for 8 months and come back, and during that 8-month period, we're still able to treat them as non-residents. Because their intention was to move abroad, things changed and they had to come back. All right, so I'm going to introduce Ernie Negrata, who is one of the partners. Ernie and I started together, I think, at Arthur Andersen in '98, so we've known each other for a long time. I'll let, do you want to tell them a little bit about you, Ernie?
Sure, yeah. So, yeah, as Wayne said, we met back in the day at Arthur Anderson and became partners, as well as our partner Todd. Wayne hasn't aged a bit. I am definitely getting older, but he, I think, is getting younger. I run our global mobility practice at Trowbridge, and also I've been pretty heavily involved over the years with our Canadian rental division. So I thought I'd do a couple of these slides for you and help answer any questions. So a very large, an area that I find a lot of expats are interested in is, can they own property in Canada as a non-resident? So we get into scenarios where either individuals are looking to rent or sell their former principal residence, or as a non-resident, they look to purchase in Canada, because many people, while living abroad, might choose to rent. They might not be, comfortable with buying, or they'd rather save up those funds to purchase a property in Canada to maybe eventually live in it or continue to rent it out to a third party. So it's an excellent option. You are able to own a property as a non-resident. As Wayne was talking about earlier, in terms of, the treaty, we want to make sure that you minimize your residential ties, and renting the property to a third party and meeting the non-resident reporting and withholding requirements does not deter you from being a non-resident. So it wouldn't be seen as a residential tie as long as you're following the correct process. So let me just walk through a couple of these requirements with you now. Next slide, please. So the first one is, if you rent out a Canadian property, you do need to meet the non-resident withholding requirements. And what we call, there's basically two methods. There's what we call the gross method basis, and that's where you withhold 25% of the gross rent and remit it on an NR4 on an annual basis. And the other option is the net method basis, which is 25% of the net income, which is then withheld and remitted to the CRA. Under the net method basis, you do have to engage a Canadian agent. Trowbridge is registered as Canadian agents. We do non-resident rental returns for hundreds of clients, and one of the things we do is manage that non-resident withholding process. So just very important to note that if you do follow the net method basis, that you engage a Canadian agent to do so. And then each year, irrespective of whether you have net income or a net loss, you do need to file a Section 216 non-resident rental return. Obviously, there's going to be more withholding under the gross method basis, so there'll be more of a refund on that return if you follow that process versus the net method process. So we usually find clients that have high dollar value rentals, they typically will follow the net method basis, so that less money is sitting with the Canada Revenue Agency and really with the owner, so that they can use those funds to manage the expenses on the property. Next slide, please. Now, another very important area is the sale of Canadian property. A lot of people feel that if they're in a net loss position, they don't need to really do anything, and that's not true. Whether you're in a net loss or net gain position on the disposition, you still have to file what's called a clearance certificate. Typically, a firm like ours would be engaged to handle the calculations for the clearance certificate, and then once that's done, we would then correspond with the lawyer to make sure that if there are any non-resident withholding taxes that need to be remitted to the CRA, that those are done within 10 days of the date of sale. Very important that you meet this 10-day requirement. There is also a requirement to file a non-resident sale of property return, again, whether you have a net gain or net loss. It's very important that you meet that requirement. Otherwise, for not doing the clearance certificate, there's a strict penalty of $2,500 per taxpayer. So if you had a husband and wife that own a property in Canada and they don't meet that requirement within the 10 days, then there would be a penalty. So I'm just going to hand the slides back over to my colleague, Wayne, and I'll be available later for any questions as well.
Thanks, Ernie. And one thing I'd like to mention is we actually have a non-resident realty group that handles all sorts of the rental requirements or the clearance certificates or anything like that. So definitely happy to help. Okay, I somehow did something. So one thing that I'm going to talk about now is amending prior year tax returns. And so what happens is a lot of times people will, they'll leave Canada and they won't file the proper tax return. Like they won't, they won't indicate that they became a non-resident, and so there's issues with that. So what you can do is you can go back and amend your tax return to turn it from a regular return to a departure tax return. You can also go back up to 10 years under the fairness provisions to correct tax returns, and we're actually doing that for 2 people now. And what happened is 2 people moved, and I think they were actually both moving to Qatar. And for some reason, they were told that they were still residents of Canada for tax purposes and had to pay taxes in Canada because they had a few ties. And so what we've gone back is we're going back and amending the returns for 10 years to get back the taxes that they paid for the 10 years, which is going to be a very, very significant amount. So, if you have done something wrong, if you're living abroad and you had improper advice and you want to correct something, you can easily go back and amend the return. So I just wanted to mention that. Okay. So now there's also a voluntary disclosure program. And this is if, you're living in Canada and you realize you did something wrong, or if you moved abroad, for example, and then you didn't include like the forms that you needed to in your departure return and you're facing a lot of penalties. Now, what happens is under the voluntary disclosure program, if you come forward and disclose your errors, they won't hit you with any penalties. So I'll give you an example. So my grandmother, so she immigrated to Canada in 1950. So she turns 97 next month, and she's in amazing shape. So that's great. So she immigrated to Canada in 1950, and she had money that she kept over there and inherited from her mother. And she didn't include that income on her tax returns because her local tax person said, no, that's income, that's assets that are abroad. You don't need to report them. And then so I was talking to her one day and I said, no, you need to include this income on your tax return. This was before I did her taxes. And so what she did is she talked to her accountant then, and the accountant went and included all the income for 15 years. So what ended up happening is she ended up getting a bill from the CRA for $80,000. So at that time, I was not the favorite grandson for bringing this up, but no, she was happy to do things correctly. But the problem was that she didn't go through the voluntary disclosure program. So the tax owing was $40,000 and the penalties were $40,000. Now, had she gone through the voluntary disclosure program, the CRA would have waived the penalties, because the whole purpose of the program is to entice people to come forward. But if they know they're not going to pay, if they're going to pay penalties, then they're less likely to do so. You're still always going to have to pay the tax, but the penalties will be waived. So that's why if you have done something wrong and you want to correct it, that's why I recommend making sure you do it through the voluntary disclosure program. So I love telling that story about my grandmother. So now I'm going to talk about a lot of you have probably there's some people that are abroad that are thinking of moving to Canada, or people that might have recently moved to Canada. So I'm going to talk about some of the issues about when you're living in Canada, when you're back in Canada, things like that. So, say you're living abroad and you move back to Canada. One thing that happens is you need to file what's called an arrival of tax return to let the CRA know you're back in Canada or you've moved to Canada permanently. And again, this is like a normal tax return, but on the first page of the box it says, did you enter or leave Canada? And that's how you let the CRA know that you're in Canada. Now, what happens is, say you move back June 1st, any income you've earned before June 1st is not taxable in Canada, assuming it's from foreign sources. So what we see a lot of, especially we do a lot of work with Aramco people and other people that are getting what's called like an end of service payment. So what we recommend doing is making sure any payments, bonuses, end of service, or anything like that are paid to you before you move back to Canada. Because if you receive them when you're back in Canada, so say you move back June 1st and you get this big payment June 15th, all of a sudden that is a taxable payment. So what we recommend doing is don't come back June 15th, come back July 1st. So it's important to ensure you get any payments that you're owed before you come back. Because as mentioned, you're taxed on your worldwide income from the day you become a resident. So June 1st, if you have a rental property somewhere in the world, that rental income becomes taxable. You know, say you have a portfolio in the US, that becomes taxable from the date you arrive to Canada. So any income is taxed from the date you arrive in Canada. So that's why it's important to ensure any big payments are paid to you before you come back. And again, if you have assets over $100,000 abroad, it's very important that you report them on the T1135 form. Otherwise, there's penalties of $2,500 a year, and that can add up over a few years quite quickly, especially if there's two spouses that are faced with this penalty. One other thing I'm going to talk about, actually, I'll go to it, is granny trust planning. Now, there's not a lot of planning, really good planning that can be done anymore in Canada. But one of them is if you're going to inherit money from abroad, if you put it into a trust instead of receiving it directly, there can be some significant tax benefits. So say both your parents are not living in Canada and you're going to inherit $1 million. Now, if you inherit the $1 million and they give it to you, that $1 million is not taxable in Canada. However, if you earn 5% a year and you make $50,000 per year, that income is taxable. As an estimate, say you pay 50%, so you pay $25,000 a year in tax. Instead of receiving the inheritance from directly, if it goes into a trust, you can pay the $50,000 out in the subsequent year, and it's deemed to be a payment of capital and not taxable. So this doesn't work in a lot of situations, but if you are going to inherit money from, and it doesn't have to be, they call it granny because it used to always be the grandmother, I guess, that the money came from, but it can actually be anyone, your brother, your sister, aunts or uncles or parents. So if you are in a situation where you're expecting to inherit a lot of money, then you might want to consider this planning. The important part about it is that the person who you're inheriting the money from, they can't be coming to Canada, because if they do come to Canada, then it changes everything. So, this is just one of the plannings to talk about. Now, again, I'm just going to talk about the taxation of certain foreign assets. So any type of an investment income, interest or dividends that you receive from foreign countries, they are taxable and they get added on to your income. So if you have $10,000 of foreign dividends and you have $100,000 of income, all of a sudden now you have $110,000 of income. And so any extra income is taxed at your marginal tax rate. Now, if you paid any foreign tax, so if you paid any tax to, say, the US or something like that, you get a credit for that. So there's no double taxation, but you end up paying the higher of the two rates. Foreign rental income is taxed exactly the same. It's added on to your income, and it gets fully taxed. Capital gains are only taxed at 50%. So if you have a $100,000 gain, only 50,000 of that is taxable. So we'll see a lot of times clients will sort of lean towards maybe capital appreciation or getting capital gains. That's not something we advise on, because we just do the tax, and that's something that you can talk to Nadeem and his team about. But right now, capital gains are only taxed at 50%. That very well may change in Canada, given the big deficit and debt we've incurred because of COVID. But right now, that's the way it is. One other question that comes up all the time is transfer of cash. So if you were transferring money to Canada, that's not a taxable event. So for example, say you receive a bonus of $50,000 when you're living abroad and you're non-resident, that transfer of cash is not taxable. Even if you're living in Canada and you have money abroad and you transfer it into Canada, that's not taxable because it's already considered like paid up capital. So it's only income that is taxed. The transfer of cash across borders doesn't cause any issues. So one other thing I'll talk about is if you, when you arrive on Canada, you're deemed to have acquired all of your assets at the fair market value of that date. So for example, say you bought a stock 10 years ago at $1,000, and now you move to Canada and it's worth $10,000 and you sell it for $10,200. The gain that happened before you came to Canada is not taxable. So you're really only paying tax on $200, which is a gain from the day you came in to the day you left. So that's why it's important to ensure you get valuations of all of your assets on the day you move to Canada, whether it's a foreign rental property, whether it's an investment portfolio in the US, or any assets around the world. It's important to get the valuation on that date so that you can calculate the gain going forward. All right, so that's it. So our professional services, we really help anything related to expats. You know, we'd like to talk to people before they leave, but sometimes that doesn't happen. So we're always happy to talk to people after they've left as well to make sure they've done anything properly. We can help with the final tax return to get people out of the system. We can help people when they come back. If there's foreign assets, we can help people with tax returns while they're here in Canada. We have a whole non-resident renting group, so we can do all the rental returns and any planning coming back to Canada as well. So basically anything to do with expatriates or anything with international tax issues. All right, so should we go to the Q&A?
Yeah, sure. Thanks again, Wayne and Ernie, for your presentation. So we're going to get started on the Q&A. And again, I encourage everyone to just kind of drop in your questions in the box below. So I'm going to start with this. Okay, what's the policy for bringing funds from outside Canada as a result of previously matured life insurance policies brought and contributed outside of Canada? I guess this is a life insurance question.
Right, so that's a little tricky. So I'm not sure if it was, you know, did it mature outside of Canada? Was there income earned every year that would have been reported, like investment income? But otherwise, the capital component should not be taxable. So,
okay.
I would think that, you know, if Mohammed, if you could email me with a little bit more information, I'd be happy to respond because there's a few kind of unknowns there. So I'm definitely happy to answer that by email.
Okay. I think you answered this question during the presentation. This is from an anonymous attendee. Working outside Canada, and upon my end of my service, my employer will pay me a 1 month salary for each year I worked. How to treat that big payment once received?
Yeah, and this is a big issue, and this is why I brought it up during the presentation as well. So as long as you receive it before you come back to Canada, then it's not taxable. If you come back and you receive it afterwards, it's taxable, as I mentioned. So it's really important to ensure you plan for your arrival back in Canada to make sure you don't inadvertently create a whole host of taxation, especially if you've worked a long time abroad. So.
Yeah. And so this question comes from Jamil Nagdi. It would be useful to get your perspective regarding situs tax for U.S. UK owned stocks by U.S. UK non-residents. I don't know if this is going to give like Jamil is a resident of South Africa, so I don't know if that makes any difference.
Okay. So yeah, so it's funny. So I lived in London for 12 years. I'm not a UK expert, even though I've spent a lot of time there. So for US capital gains, there should be no tax on the capital gains. And also for the UK, I'm not 100% sure about that. But the UK, as long as you're non-resident for 5 years, it shouldn't be taxable. There would be withholding tax on the U.S. dividends at 30%, unless the South Africa-U.S. treaty reduces that. But the capital gains should not be taxed. You know, I mean, for the situs, depending on the amount, you know, there is U.S. estate tax and U.K. estate tax to consider as well. So that's one other element. Sometimes tax gets withheld on sale of US shares if proper forms like a W-8 Ben hasn't been completed. So you want to make sure that that's not happening. So,
Yeah. All right. Well, those are standard documentations for us.
yeah.
All right. This one is from Fatima Goose. I was made to understand that all cash inheritances are tax-free. So why would you want to create a trust to receive the inheritance? I guess
So yeah,
this is granny trust, right?
yeah, so that's the granny trust. So it's really to protect the income going forward. So again, in the example, if you receive $1 million from, say, parents, that inheritance is completely tax-free. And if you plan on spending the $1 million, say buying a house or something, then there's no point in putting it into a trust because it's still tax-free. It's just a way of the trust makes it so that any income earned on that money isn't taxed. So that's the whole person. The whole point of it is to protect the future income from taxation. And sometimes we'll see people will inherit $5 million, and maybe they get a 10% return on that some years, and that's all of a sudden that's a big amount of tax that you would pay. So again, yeah, if you're inheriting a lot of money, you might want to think about what you're going to use it for and whether a trust might make sense. But to confirm, the inheritance is not taxed.
Yeah. This comes from Saud Ghanem. What happens if I receive rental
Okay.
from abroad and I don't want to declare it as income in Canada? There is no way for the CRA to find out.
Okay, so normally it's funny because when I do my presentation live, I normally say, you might want to word the question as, so my brother wants to do this, or my uncle, or my friend. So I'm sure you don't want to not declare the income. But there is a way for the CRA to find out, and this comes up all the time where people think they're in a loss position, right? And they don't file a rental return. And then what happens when they sell the property, the lawyer has to withhold 25% of the gross proceeds until a clearance certificate is granted by the CRA. And then when you go to the CRA, they're going to say, well, what was happening with the house? And if it wasn't rented out, then is this person potentially a resident because they have a home available for their use? So we typically always recommend just filing the rental return. You only pay tax on the net income, and it's taxed at the lowest tax bracket because there's no other income. So you're looking at 22% of tax. And you can write off mortgage interest, property taxes, repairs, condo fees, accounting fees for preparing the tax returns. So it really is worth it to just file the tax return and be done with it. Because a lot of times people don't even end up owing tax when they have all their expenses. So.
Right. And this is from an anonymous attendee. What happens to inheritance land? Say, for example, when the Canadian citizen gets them, are they supposed to disclose those?
So what's that again? It's to land when the Canadian citizens get them. No. Or yes. I guess it depends. So if the land is not earning income, then there's nothing to disclose. But if the land is, I'm assuming this is land abroad, if the land is earning income, then you need to disclose it. But if it's just land and there's no income, you don't have to disclose it until you sell it.
Okay.
And this, I'll give you an example. This is, say you have a property in Florida, right? You don't have to disclose it. But if you rent it out, you have to disclose it. So it's kind of, they want to know it. They want you to disclose anything that's earning income.
I see. That's good to know. Okay, if I am considered a resident for tax as my family is still in Canada while working abroad, and I spend less than 6 months in Canada currently, does these facts affect my TFSA yearly increase entitlements or affect anything with my current RSP dealings?
So in this instance, and again, I don't have that much information, but it's very likely that this person is still a resident of Canada for tax purposes. So then they get all the benefits that residents do. So they would get the annual TFSA contribution limit. The income that they've earned would generate RSP room. So they would be able to use all those benefits to reduce the tax or to shelter future gains in the TFSA from tax.
So I guess ultimately it comes down to a question, are you filing CRA with the CRA, right?
Yeah, and that person more than likely should be a resident and should be including their worldwide income. So they assuming they are, then they would get all the benefits.
Okay, and this is a follow-up question from Jamil again on the situs question earlier. I was keen to understand if there are any ways in which the investment could be structured more efficiently to minimize the situs taxes for family members on death. Could a granny trust or similar structure be used? And what are the annual costs of these structures?
Yeah, so that's a great question and very complicated. So there's definitely trust structures to avoid U.S. estate tax and to avoid UK death tax. We have people that do with both those in the UK and the US. So if you want, you can message me, but that's not my specialty. I don't know enough of it to sort of answer that in more depth. But I could put you in touch with a few people that's their real specialty.
Okay. All right. All right. Okay, this is from an anonymous attendee. When I am asked to fill out the form that is sent from my bank regarding residency, I declare that I am a resident of Canada, as I am still considered a resident for tax purpose, although I am working outside Canada. Is that okay?
Yeah, that's correct. That's the best way to do it. And that's the exact way to do it, because they really want to know what's your residency for tax purposes so that they know what countries should be collecting the tax.
All right, and this is a question coming from Nadeem Ahmed. Do we have to bring the overseas assets, investment properties to Canada? That's question one. And then he's asking, can we keep it outside and just report the income and pay tax on it? Reason being, investment vehicles are limited in Canada compared to outside world.
Yeah, for sure. You can leave your assets anywhere in the world. And we have a lot of people that invest in the US, right? So there's no problem in doing that for the exact reasons you said. As long as you're just reporting it on your tax return, then there's nothing to worry about. So yeah, so you can invest anywhere in the world. Just make sure you're reporting the income and the holdings on your tax return and you're fine. So there's no problem with that.
Yeah, as portfolio manager, we also get a lot of those questions because a lot of our portfolios are kind of ex-Canada in U.S. markets. So yeah, I can relate, I guess.
Yeah, no, and that's exactly it, right? If the return on the investment is better outside Canada, then
Yeah.
you know, and invest outside Canada for sure. So just declare it.
All right, just a few more here. From Fatima again, as non-resident Canadians, if you transfer your house to a child who is in age of majority, will it amount to cutting off ties, and will the basis be the market value at the time of transfer?
Okay, so this is a great question. Now I'm gonna answer generally because I don't have the other facts. So again, it kind of depends. So, you know, if the plan is that you don't want to come back, you're not coming back to Canada, and you're going to, you know, live abroad, and you just want a home for your children, then that's actually a good strategy, because if they're living in it, what happens is they're eligible for the principal residence exemption, whereas non-residents aren't. So any future gains are tax-free for the children if they own it. Now, one thing is that, you know, if you just transfer the property to your children, you come back in 2 years and you take it over, then the CRA could look through that and say, well, you know what, this was just really a transact, kind of it's called GAR, like it's a general anti-avoidance rule. You just did that so that you wouldn't be seen as a tie, but in reality, you planned on coming back, and then that's why you took back the house. So we have done that for a lot of people. It is a solid strategy. But what does happen is that it's deemed to have been sold at fair market value. And so any gain would be taxable at that point. And you have to file a clearance certificate, as mentioned, as Ernie talked about. So definitely a solid strategy. Can definitely get rid of that as a tie. it really depends on a bit more of some of the other facts as well.
Okay. This is again also from Mohammed Siddiqui. For the land outside Canada, not generating any income, once you sell that, how to bring that money to Canada? Would that be taxable?
So what happens? So say you inherit the money. I believe this was an inheritance thing, and the property is worth $100,000. That's why it's important to ensure you get the valuation at the time of inheriting it or buying it, right? And then you sell it later for $120,000. Now, the only thing that is taxable is the difference between the purchase price or inheritance price and the sale value. So it's only the $20,000 gain, and only $10,000 of that is taxable. So you might end up paying $4,000. So it doesn't matter if that $120,000, if you transfer the money to Canada, if you leave it abroad, that is not the taxable element. The taxable element is the gain on from when you inherited it or bought it or to when you sold it. So the transfer of cash in that instance doesn't make a difference.
Okay. Okay. My parents were overseas for a while and did not file taxes then. One of them got sick and has been here for the past few years, but we have never filed taxes for them. They are citizens. Is it a good idea to file back taxes for 10 years now?
I mean, I guess that depends. If there was no income, then they might not be subject to any tax. But there's also like old age security, where you have to have lived in Canada for a certain amount of years, and if you don't file, that won't be in the system. So you might want to look at it, and there could be other benefits that they could have got as well. Or maybe, I don't know, if they weren't working and maybe there's low income, or who knows. So there could be other benefits. And then also they might have had the filing requirements, might have been technically required to file. So, they probably would in that instance as well. So it's definitely something you'd want to look into, and if you want, you can send me an email and then I can let you know how we can help.
Sure.
And then, so just even quickly on that. So how we work with our clients is we always do everything fixed fee. So we'll get an idea of your situation, and then we send out an advanced fee quote that's always fixed. So there's never any surprises and there's no changes. So we always take a look at it, get as much information, and then quote later. So.
Okay, just a few more questions here. Just to make sure, if you own land outside of Canada that is not making income, then you do not have to report it on the T1135 form. I have been reporting so far. What should I do?
Honestly, like over-reporting in this situation is not gonna create any type of problem. So I would just keep doing it, so.
All right.
Yeah, it's not a problem. It's never a problem to over-report because you're just reporting it, and there's no income to report, so you haven't excluded any income. So.
Okay. Does a Canadian citizen of U.S. resident need to disclose income earned from rental property to IRS and CRA?
So in this instance, I'm going to assume the person is a Canadian citizen, but is a U.S. resident for tax purposes.
Yeah.
If so, if they have a rental property in the U.S., they don't have to report it to the CRA.
Okay.
Now, if they moved back and became a resident of Canada for tax purposes again, right, then they would have to declare that U.S. rental income. So.
Right. Okay. So
and sorry, vice versa. If they're in the U.S. and they have a Canadian rental property, they have to disclose the Canadian rental property to the U.S. as well.
okay. I think you've answered this before. What happens to inheritance land? Say, for example, when the Canadian citizen gets them, he's supposed to disclose those. I think you've already answered that, right?
Well, you don't actually have to disclose it if it's not earning any income.
Okay.
But you need to keep record of the value of that date. So that when you do sell it, you have a valuation to compute the gain.
Okay. And so this is our last question for the webinar here. If I immigrated to Canada and owned property and assets I did not disclose because I did not know I had to, how do I correct this, and what are the tax implications?
So this is the exact perfect situation of like my grandmother. You'd want to go in and look at, you'd probably want to look at doing a voluntary disclosure, and you'd want to calculate, what the amount of tax owing is, And then you would go back and amend the tax returns to include the income or the assets and see. And sometimes there's not even that much tax owing. It just depends on that. So I think you'd want to look at it kind of sooner rather than later, and then come up with a plan about how to correct things. Most likely through the voluntary disclosure program.
All right, perfect. All right, so again, thanks again, Wayne and Ernie, for doing this with us. We hope all our attendees, took this information and it was valuable. Please contact Wayne or Arun for any specific tax questions that you might have. I believe we have their contact information. It's in the email, but I think we'll also send a follow-up. And so that's about it. So again, thanks again, Wayne. Thanks again, Ernie. And we look forward to our next webinar, hopefully soon.
Okay, thanks, Nadeem. Really appreciate it.
Okay, thanks.
Have a good day.
Thank you.